All right. Good morning, everybody. We made it to Friday. So we've been waiting all week for something. We really didn't have any economic calendar events, but we had the looming overhanging tariff talk all week, which continues even into today. And really it's the only thing out there to focus on at the moment. We have CPI next week, which really isn't going to help us out. And then we're going to kick off earnings season next week. But still got to make it through the day. So US markets are down. Europe's down. Japan is down. Only Hong Kong is up. And I would say that that's probably not right. Oftentimes, this website doesn't do a good job when it comes to indexes around the world. It's just a brief snapshot. So at 2 o'clock, we're going to have this budget data. And you can see it's a bit wide between previous and forecast. That's not really expected to be anything impactful. So we'll get it. We'll get through it. The main thing is just going to be headlines, which it has been most of the week, and keeping track of whether or not we're going to make it out of this range. Range is pretty clear at this point, 62.50 to 63.50 if you want to round a little bit. So 100-point range. It has spanned now for a week since we started to develop it last Thursday into Friday. And here we are Friday morning with the day half done already. We are below the 3-day, which is, something we've done multiple times this week. We have to cut under the 10, and then we have to get the 3 to cut under the 10 to have a bearish surge. If you look at it on a daily rather than looking at it on the intraday, there's the 3, there's the 10. We've been cutting underneath that 3 all week. But other than Monday, we've been able to come back up through it on the other side. As long as we're still holding above the 10, then this run is just going to continue. If we're looking for a 310 surge, we got to get something like we had back here. But we actually have to get that white line to cross through the line. Like we had here. White through blue is surge. Blue through green is momentum. Green through orange is trend. Get the idea. All we have right now is a really beautiful fork pattern with all of the moving averages spread out nicely and not even a single test of the 10 since we got through it back here. So if you're looking for shorts, I would put some time on it because even if we do drop, we're going to have a first touch play on the 10 very likely. So we'll get to it and we won't be able to get through it on the first try. And we'll come back up and have to try it again. That's even if we can get a short, right? We got more participation in the overnight last night than I think we've seen for the whole week. 77. Yesterday was 50, 45, 49. Yeah. We've been less than 50 all week. we got 77 today, so a little bit more participation. The initial balance spread out really nice, or I should say we spread out right after initial balance. We can see Asia's move. Europe didn't counter it, and now here we are. There's not much of a VWAP reciprocation at this point. We really didn't outrun it by much, just been taking it nice and slow, and we're getting a little bit of a reset here. But so far, we've got nothing to work with. It's just a boring, uneventful day at this point. But the market is expecting some trouble. That is a market maker move tag. If you don't have Thinkorswim, you've probably never heard of it because they made it up. What that tag tells us when we're looking at the futures is that they are hedging this morning in the front end. So let's just scrunch things up here a little bit. We can see the dates, and we can see this implied volatility average. When the average in the front is higher than the next average out, it is considered a market maker move. All right, that's where it comes from. So if you don't have Thinkorswim and you want to see if we do have a market maker move, just bring up your options chain and look at the front expiring options implied volatility average, and then look at the next one out. If the front one is higher, then you have that market maker move. They are hedging, and unlike you and me, when retail hedges, we can often just do it as a trade. Our risk is defined by the trade that we put on, and we can usually manage to work it out. For them, when they hedge, it's just cost, right? It's just like insurance. You don't get money back when you buy insurance. So they're spending money today to protect themselves, and they are always hedged. It's not like they were running around without a hedge and now decided to put one on. No, they already had it on. This is additional hedges. Something today has them worried enough that they are spending more money for an additional hedge. And we just looked at the economic data for today. We don't have anything worthy of that sort of commitment. So as usual, they know something we don't know. That's not a surprise. Whatever the threat is, they deem it necessary to get some extra protection. So proceed with caution today. And if there was ever a day to where you could use, 0-day options with far out of the money, really cheap lottery ticket, long calls or long puts, it would be a day like this. We've been sideways all week. When we go sideways, we build up energy. We learned that through the RSI Laguerre tool. So if I was to turn that on, it would probably show that we've got a really high gamma load and we're ready to make a move, right? Like the battery is full, the car's gas tank is full, however you want to say it. We're loaded up and ready to bear. All we need is a trigger or a catalyst, and we could move. Another way to define this, it probably isn't a TTM squeeze yet, but it's likely close to a TTM squeeze at this point. And of course, I could turn on the more fancy squeeze tools, but this'll do for the conversation this morning. No squeeze. This range is what we've been working on for a week. This tool says it's not necessarily a squeeze, although we were squeezing right there through this really narrow range Monday and Tuesday. Either way, when we come out of this box after being in it for as long as we've been in it, it's very likely going to be violent. So that's what we want to focus on. We've already reached the ADR on the lower edge. One thing I've often talked about is if we get to one ADR early enough in the day, we can go to the other one by the end of the day. And it wouldn't be bearish or bullish, right? In this case, we reached the lower one. We could go to the upper one by the end of the day, and we wouldn't consider that bullish. One thing you want to focus on is where did we close? So Tuesday was there, Wednesday was there, Thursday was there. The closes are higher. That's the turn, right? As opposed to that close, that close, that close. So there was the turn. We started our way back up, and just regular market function, setting higher highs and higher lows. Not in this case, right? We actually went down here a little bit, but we could megaphone and set that higher high, which would put us into the upper ADR by the end of the day. And that wouldn't be bullish, right? That would just be a part of what wave we're currently experiencing. Because it's what markets do, is just run that wave. Now, we don't have today's close yet, so we don't know if we're going to get that higher. But that's what we've been establishing since the turn back here on Monday and Tuesday. With the higher close Wednesday and the higher close Thursday, we've already started to turn it around, and we're getting the higher highs and the higher lows. Having said that, if we can't get back above this ADR half, if we continue to stall out here, then it opens the door for us to go to the next ADR level, which is what we call the full ADR. This is the ADR in the upper left. Right now it's at 1.4%, which is about 65 points. We're only down 0.5%, so we could complete another 0.5% and get into that 104, right? From where we opened last night, if we just move down 1.4%, we would be at that yellow line. That'd be a full ADR. On top of that, we can add the market maker move to that, so we could put in another 0.34 on that and go even lower. A lot of analysts say in times of crisis that we can triple an expected daily move. The daily expected move right now is 54. So we could make 150 easy, right? It'd actually be like 162 or something, but get the idea. Especially if it's a downside move. So whatever is causing this market maker move, whatever fear is causing this market maker move, let's say it that way. If it's a catalyst that really does kick off in the market, then the move could be exaggerated considerably. The way I like to run situations like this is once we get into the open, just start shopping for options far out of the money at whatever price you're willing to spend, right? So if you say you're willing to risk 2 pennies, then you would go out of the money until you find 2 penny options. If you're willing to, increase your risk and you want 10 penny options, then those would be the strike that you would pick. Because on these 0-day strikes, it's not going to be some magic formula of the right delta and the right theta and the right Greeks, and just pick the strike that is the amount of money you're willing to lose. And it would be a loss, right? If you go far out of the money on a 0-day, it is a pure lottery ticket. There's no defense. There's no saving it later. It's just going to make you money or it's going to turn into smoke. So be prepared to lose that trade. But we are primed for a really wild day. All we have to do is break out and start the run. Just keep in mind that 63.55 is on the table because we got to one edge early in the day. So it's not all about bearish either. We did reach the lower edge of the weekly floor pivot. And one of the things we had noted this week was how we opened in relation to the weekly pivot. Whereas last week when we opened, we were far above that weekly pivot. And we really didn't have much room left to the upside to travel because we were so outstretched or overbought, or pick whatever word you want to use there. This week, we were on it when we opened. Then we fell below it. We got back above it, but we've really just been chopping in a zone around this weekly pivot all week. Haven't been able to get anywhere. Today's floor pivot is higher than yesterday's. That's considered bullish. Price opened above it. That's also considered bullish. But then we broke down through it and we've been underneath it. You know, it did show that China was the one that was off, right? Hong Kong up a half. And I said that it's very likely just not right, right? It gets things wrong on this website because they're generic. I would say they're down on the day. Yeah, that was their trading day. That was the run up, which is probably why it was reading 0.5% to the upside. It just didn't capture that part of the day. Yeah. So the narrower channel for today, it is narrower than yesterday, but it's still a relatively wide channel. It implies that if we break out, the breakout doesn't stick. Well, we already did break out. And sure, we're working our way back inside of yesterday's range at this point, but these channels don't make price do anything. They just give us insight on what to expect with price and whether or not we get a breakout, what should happen. We still have a relatively nice distribution this week, all things considered. The value area is relatively tight, and we've tested the point of control now in the later part of the week and seen a response there. Keep your eye on that level if we go back to it, 62.75, 77. We've seen it be defended now twice. Back here, they defended it. And then here again, they defended it. When they finally get out of the way, then we can check these lower levels, but we got to do it first. There is a trendline breakover already happening as well. We've broke it and we've started the move, which owes us back down to 62.50. There's just no saying that it has to happen today. And yeah, there is a ugly little scrunched up head and shoulders too, but I wouldn't let that be the basis of any of your decision making. Head and shoulders are like the butt of all jokes when it comes to price action, right? You got good patterns, decent patterns, okay patterns, and then you got ones that we just laugh at. And the head and shoulders is the one that we just laugh at. 10-day, 30-minute volume profile with TPO. The TPO's value area is still really tight, and the volume profile's TPO value area is still really wide. Still looking to see that tighten up. The point of control did move for TPO, but it hasn't moved for the volume profile, so that's what we're still expecting to see. As I mentioned yesterday, that's not likely to happen unless we come back down into that level, put in the work to bring the volume up. Otherwise, we're just waiting until we reach these candles, which we won't get to for another 3 days. We start taking these candles off the table, and then that point of control is going to move by default up to the next location. The concern is that it'll get up there, but we'll already be below it, right? If we do manage to get down into 6250, then that point of control next week is going to be over our head, as opposed to, 6250 right now. If we get down in there, that puts us at this point of control, helps us out like it did back here. Well, that's an ugly distribution. Yeah, that's what she said. So no VPOC for today. We've already cut through that level. No discrepancy between the TPO and the volume profile on today. And it's really ugly with no distinct pattern to it. No classic shape, no real insight. And they're, other than the value areas, they're pretty much in sync. So no help there. We got a preview of next week's range. Now, this is just a preview. It won't be set in stone until the end of the day today. But one of the things that I like to do on Fridays is take the week's range that we currently had and compare that to next week's projected range. Now, notice I'm not getting the calculator out and trying to get the box to be 100% to the tick perfect. I don't care, right? I'm not some Canadian engineer. Good enough. All we want to see, visually speaking, is next week's range as big as the current week's range, or bigger or smaller? There's two metrics that make this range. One is time, how many days we have in the trading week, and the other is volatility. Some trading weeks, right, is a 5-day week, some's a 4-day week, some is a 3.5-day trading week. So not all trading weeks are 5-day trading weeks. And then volatility changes. Well, next week's a 5-day week. This week is a 5-day week. So the only thing that's different in these two boxes is how much volatility there is. When volatility is greater, the box is wider. And when volatility is lesser, the box is narrower. Pretty simple. At this point, there is more volatility being priced into the market next week than there was this week, which kind of makes sense because next week we have CPI and we have the start of earnings. And this week, we didn't have any economic events on the table of note other than a little bit of unemployment stuff. That was it. Now, the sneaky part of all of this is that big economic events actually suppress volatility. So if next week was FOMC, that range would be much narrower because the market would be expecting to go sideways into FOMC. So just because it's a bigger range doesn't mean that you can expect big ranges on big economic events. It's a little odd in that sort, right? It gets a little tricky when we start playing around with that. So the main thing of note is if you find it really narrow, you want to go looking around and making sure that there's no big economic event on the horizon that's scaring everybody and putting us into a hurry up and wait mode for next week. I was talking to a coaching client yesterday about recognizing that today is supposed to be a breakout day or not, right? That we can identify that most of the time before the day even begins. And a lot of times we can do that this Friday before the week even begins into next week. And if this had been a very narrow range projection for next week, that's what it would have implied, is that, hey, it's not supposed to be big breakout days next week. We're supposed to go sideways all week, or at least sideways into whatever event we had. We had the same discussion for this week. right? We couldn't compare it to the previous week because that was a 4-day. We actually compared it to this week back here. And we could see that the week that we just had was much narrower than the week that we compared it to. And this week was a hurry up and wait week. What did we do most of the week? Nothing. We went sideways. That was expected. That's what we talked about last Friday. It's what I talked about on Monday, that it was a smaller week. With the expectation is we weren't supposed to go anywhere. And golly gee gosh, guess what we did? We didn't go anywhere. Surprise. We're still at 4% above the 10-week. This is a good place to be, but it does limit our upside move. We're talking about the potential for a big breakout day today. If we make that big breakout move to the upside, how far could we really get? I mean, another 1%, possibly. And then we're going to run into some trouble when it comes to the 10-week. The 10-day, however, we've got room to move. So we're at a 0.5% above the 10-day, and we could get, into 3.5%. So that's a 2.5% move to the upside. And if we're down 0.5%, then we could make that half plus another 2.5 on top of that. Be a nice move for the day. I'm not saying we're going to get it. I'm just saying that after reaching the lower ADR this early in the day, we can go to the other side by the end of the day. That's the way it is. Not that we will, just that we can. Looking at what's up or what's down today, 0.5%. We'll start with the downside, I suppose. The S&P is down 0.5% with tech, industrials, building materials, chips, finance, uranium, bonds, just about everything we would want to see for a rally day is down. Now, the Mag 7 isn't down 0.5%, so we have that on our side, but they are down on the day. We would need to turn that around, and they're down on a 5-day period. So, spanning the change over the last 5 days, they're down over 1%. Even if we wanted to turn that around, it's got work to do. Looking at things that are up this morning, I was surprised to see Bitcoin, right back into that 118 level already. I thought it would take a little bit more time. But it's good to see, right? Because Bitcoin is our indicator of risk appetite. So seeing them jump into Bitcoin kind of implies that this growth value shakeout that we've been seeing and this short covering squeeze that's been happening is very likely going to dry up a little bit. Oh, it was kind of fun seeing all these penny stocks just face ripping, but nothing lasts forever. So we got Bitcoin and precious metals, gold miners, a little bit of China, but it's not up enough, so it needs some work. Still, it's at least positive. We can't say that about chips and the Mag 7. So if we're going to get a rally day, that'd be one of the things we'd want to watch for, right? Is that those metrics start to turn around. Not necessarily that Bitcoin gives up, because we kind of want that for a rally day. The idea that we need the other metrics, Mag 7, chips, consumer discretionary, financials, the typical risk on subset. If we don't get it, we could still run. It would just require 0-day options trading activity, right? Which is fine. That can do the work. We've seen it do it before, but it can't run us to the upside if all of the good stuff that we like chips and all that, is still falling. So that would have to at least stop falling. And then we'd need the positive 0-day flows to push us to the upside. Yeah, I mean, SMH is down, but it's still inside yesterday's range. And look, it was down yesterday. After the open, it dumped straight down and then ran all the way back up again. So just because it's down, that's not the end of it. SMH, technology, the tech is kind of generic, but it gets the job done. Those are just algo prints anyways. We don't even have any real flow in there yet. SMH at least has some candles there, right? Same thing with finance. Yeah, it's down on the day, but it's still inside day. Well, that low has been tested multiple times this week. That's a really nice tell. Keep XLF on your radar. I think if we, I think if this goes, we go. Now it's XLF. A lot of people poo-poo on this thing and think that, who cares, because it's all about tech dominance and cloud computing and chips, and just keep your eye on this thing, especially with earnings kicking off next week. It's going to go to the heart of XLF. Maybe they start a little front running this week. Who knows, right? 52.25 or whatever this low range is. We've come back to it. We've danced around it multiple times. Often I've talked about, what do you do with a sticky door, right? When you try to walk through a door and you find it jammed, well, you back up, you put your shoulder into it. We've seen price do that before. Let's see if it does it this time, right? It's what it did back here. Reached a level it couldn't get through. It backed up, put its shoulder into it. The move to the downside for XLF, if we actually do start to run it, would be this entire measurement. All right, from here to here, down here. Just measure that, plot it that way. Or measure this entire thing and catch the half. Whatever the midpoint is between these two. 51 and a half, 51 and a quarter. Pretty simple day, all things considered. Everybody be careful, be safe, keep your eye on the news. I'll see y'all next week.